In today's video, we're running through two brand new dividend stocks that I've just started adding to my portfolio for the first time ever. Both of them have very high yields that are just about at record highs, and I'm absolutely in love with these stocks. So let's not waste any time. I'm going to break down for you exactly why I like these stocks long term. Let's get into it. What's up everyone, my name is Ale. Welcome back to my world of stocks. So like most stocks in the market this past year, these two dividend stocks have been crashing by very large amounts, and I think that's setting up for a great buying opportunity for me for the long term. And I think that's the case from not just a dividend perspective, but even from a stock price appreciation perspective as well. So let's go ahead and run through the reasons why I believe this. Okay, now the first one I purchased here was the semiconductor giant Broadcom, ticker symbol AVGO. And if you've been keeping up with the semiconductor sector, then you know exactly why I chose to go shopping in this specific market. We're looking at the PHLX Semiconductor Index, which tracks most of the biggest semiconductor stocks in America. It's now crashed by about 35% from its highs. Now, Broadcom has actually held up much better than most of those stocks because of their excellent diversification and a strong business model that I'll talk more about in just a second. But even they too have lost more than a quarter of their value so far this year. And while there certainly may be more pain to come in the near future, I just feel that I'm ready to start buying this stock myself right now, which I went ahead and added to my portfolio for the first time ever at just barely under $500 a share. And there's several reasons why I plan to continue buying from here, and especially if it happens to fall even more. First of all, the crash has left Broadcom's dividend yield at really close to a record high. Now, I say close because it was actually higher during the 2020 market crash where it soared to above a 5% yield. But if you discount that extremely rare event where almost the entire global economy was like literally shut down, then that dividend would essentially be at a record high right now, yielding about 3.5%. And yet, that's not even the best part about it. If you're at all into growth like I am, then you might appreciate how this is easily one of the best growth-oriented dividends out there. Not only is the payout ratio sustainable at less than 50%, but their 5-year growth rate is astronomical at over 32%. And that's despite the fact that they've already grown that dividend every single year since they started paying it more than a decade ago. And yet growth is not the only thing that you get with Broadcom. Thanks to the crash, you also get fantastic value with a PEG ratio that is not only below 1, which is great just on its own, but it's also 30% cheaper than their own 5-year average and about 50% cheaper than the rest of the sector. That's pretty crazy because usually growth-oriented dividend stocks like this, they tend to trade at much higher valuations. And really that's been the biggest concern, or the reason why the stock has been crashing, is because the semiconductor market is so competitive that these type of companies really need to put up very high growth in order to please investors. But coming off of the pandemic where sales were exploding for them with revenue growth of 15% in 2021 and over 20% this year, then now lower demand for tech coupled with supply chain issues are causing their growth to plummet all the way down to just 6% expected next year. Personally, I think investors have been treating these type of companies unfairly considering the really hard comparisons to the last 2 years, but regardless, it's causing the stock to crash now, and yet I still think that Broadcom has a business that is more than worth investing in for the long term, and that is being heavily slept on in my opinion. Because while I already own shares of Nvidia and Intel who have very large consumer parts to their semiconductor business, Broadcom is a little different in that the vast majority of their business is actually directed towards providing custom chips for businesses that rely on them for storage, internet connectivity, and a variety of other needs. And not just that, but Broadcom has also done a great job of expanding into software and services too, which includes the planned acquisition of VMware, who is a cloud computing giant that does everything from cloud infrastructure to apps to services, networking, and especially security, which by the way are all areas that Broadcom has been investing heavily into and expanding into in recent years. So I think there's going to be a ton of giant synergies to benefit from if regulators approve the acquisition, which I strongly feel that they will, since VM shareholders just approved the acquisition last week and it's expected to close by sometime next year. Add it all up, and I just think that Broadcom is one of the most slept on stocks in the market, which analysts seem to agree with me on, as the average price target is about $140 higher than where the stock trades today. So you just add up the strong business, the reliable growth that I think is going to benefit even more from a monster acquisition that will give them new synergies as well, and you add on a falling stock price with a fantastic valuation that leaves almost a record high dividend too. From a long-term perspective, that's a buy all day. I really like this stock. All right, now moving on to stock number 2, that's going to be the medical device giant Medtronic, ticker symbol MDT, which is a stock that I just recently featured in my stocks to buy in November video. And in that particular video, you might recall that I said I was heavily considering buying this stock, but that I would make sure to update you guys if I actually decided to pull the trigger. So here I am. I went ahead and bought the stock in the low 80s. And the reason why I'm buying now is because not only is this one of the biggest crash that I've ever seen in the stock, but at these levels, the stock is now down a giant 40% from the top, leaving their dividend yield at the highest level in history at almost a 3.5% yield, with still a good payout ratio below 50%, despite having grown that dividend every single year for over 4 decades in a row. That's almost dividend king status. And really, what I think is the most important detail of all when it comes to this crash is that Medtronic is already the largest independent manufacturer of medical devices in the entire world, and yet they trade like they're a garbage newcomer with a valuation that, after the crash, is now more than 30% cheaper than their 5-year average and more than 20% cheaper than the sector on a P ratio basis. Guys, this is ridiculous for a proven leader with a massive dividend like that. There's just no way you can justify them trading cheaper than the sector. They've got virtually the largest global footprint in their specific market with over 150 different countries. They spend billions of dollars on research and development every single year, with over 235 clinical trials performed just last year alone that, by the way, saw almost 200 brand new products approved. And they're even expanding into one of the biggest markets of the future with their surgical robotic system that will enter the close to $100 billion market that only has about 3% penetration so far. So there's giant room for growth and expansion there as well. And that's actually the reason why the stock has crashed by so much, because supply chain issues have really delayed their robot system called Hugo. Technically, there are other reasons for the crash too, like the delayed FDA approval for some of their newest products. But ultimately, these are all short-term issues that I feel are leaving new investors like myself with a giant buying opportunity for the long term that I don't think I would otherwise get. On the delayed robots front, Medtronic CEO has said that despite there being some bumps in the road right now, the robots are ultimately coming and they're going to provide a large ramp up in the coming years that will provide accelerated growth for the company over the long term. And I believe him. Hugo has been receiving a wave of regulatory approvals in recent months, including Canada, Japan, and even Europe, with the US expected to follow soon as well. As such, while their sales fell by 5% in 2020 because of hospitals closing down and nobody leaving their homes, as well as being flat in fiscal 2023 because of the supply chain issues and the horrible economy, well, the revenue is expected to start returning to a healthy mid-single digit growth rate in the coming years after that. And more importantly, their profits should start recovering as well, which is what I care the most about since it's needed for maintaining the super attractive dividend, as their EPS is expected to skyrocket by a double-digit percentage on average over the next 5 years. That's not only way higher than the previous 5 years where it was basically flat, but it should be more than enough growth for what is, again, already a world leader with giant sales and profits every year. And just like Broadcom, Medtronic is also trading significantly cheaper than not just the average analyst price target, but even the absolute lowest targets as well. And so ultimately, this is just how I feel about both of these stocks. Unbelievable valuations, very good dividends, very strong businesses that I don't think are ever going away. I mean, you're talking semiconductor markets for business, medical devices, surgical robots. Those are markets that are only going to grow larger over the long term. And I understand that right now people are predicting that stocks will head lower. Maybe these will too. And I certainly think that we will at least have continued volatility going forward. But I'm actually hoping for that. I think these are amazing stocks that get even more attractive the more that they fall. So love the fact that I was able to buy right now, and if they fall more, I'm just going to add on to my positions. They're small, they're the newest stocks to my portfolio, and so I've got plenty of room to keep buying these over the long term. So I really like them. I'd love to hear what you guys have to say about them down below. Let me know if you agree or disagree with anything I said. But thank you for stopping by. I will catch you in the next video. Hope you're all doing well. Take care. Bye-bye.